What if I told you there was a way you can get paid to buy a stock you already like at a price 11% cheaper than it's trading for right now? Most beginners think options trading is just a fancy way to gamble and lose your shirt. But today, I'm going to show you a pretty boring trade on Zoom that is mathematically designed to win, even if the stock drops after their big earnings report later this week. I'm going to show you a 1-week contract expiring February 27th, and I'm going to walk you through the entire trade. I'm going to break down exactly why the math says this is a high probability trade, why the market is tricking people with high premium right now, and stick around until the very end because I'm going to show you the one death drop stat from Zoom's history that could blow the whole trade up if you aren't prepared. And if you've ever felt overwhelmed by all the charts and the Greeks and the data, I'm building something behind the scenes that does all the heavy lifting. I'm going to give you a preview of that as well. Now, before we jump right in, be sure to hit the subscribe button. I'm putting up a video every day to help you earn income for yourself every single week. Okay, let's start with what selling a put even is. And let's break it down in super easy to understand plain English. We aren't buying a lottery ticket here. We are selling insurance. You see, Zoom is about to declare their earnings this week, and everyone gets nervous around earnings time. And when people are nervous, they buy insurance, puts, to protect their portfolio. We are going to act as the insurance company. The trade is super simple. We're going to sell the $80 put that expires this Friday. By doing this, we're telling the market, hey, if Zoom stays above $80 by Friday, I keep your money. And if it drops below $80, I'll buy the stock from you at that price. It's that simple. Now, right now, Zoom is trading a little bit above $90. So the stock has to fall more than 11% in just a few days for us to be wrong. Plus, we're getting paid a premium to take the deal, and we keep that no matter what happens. Now, you might be asking, how do I know $80 is the right strike for this trade? What makes that the magic number? Well, I didn't just guess. I've been super busy building tech tools for traders because I got tired of messy, hard to update spreadsheets. This tool looks at the last 5 years of Zoom's history and calculates the percentage move after every quarterly earnings call. And the data actually shows us something wild. Even when Zoom misses earnings and drops, it rarely drops more than 8 or 9% over the subsequent handful of days. So by picking the $80 strike, we're giving ourselves a buffer. This is what I want to help you guys do. Identify these kinds of high probability trades where the math is on your side, and you don't have to be an MIT genius to figure it out. My tool looks for strong S&P or NASDAQ tickers like Zoom and flags the levels automatically. It's about trading with a casino owner mindset, not a gambler mindset. Now, the Wall Street guys talk about the expected moves. Don't let that scare you. It just means this: how much is the market expecting that ticker to move? So based on the options price right now, the market thinks Zoom will move about $7.25, up or down. Well, if it's at $90 now and it goes down 7.25, it lands at $83. I'm just rounding off the numbers for simplicity. So do you notice something so far? We're choosing a strike that's 80, below where the market anticipates the stock to go. We're literally placing our bet outside of the market expectation. Now, we're not trying to predict the future here. We're just betting that the future won't be a total disaster. But wait a minute, I promised you the death drop stat by the end of the video. So let's talk about that for a minute. Is this trade 100% safe? Of course not. Nothing is. Back in 2021, Zoom dropped 24% right after earnings. Huge drop. So if that happens this week, our put is obviously going to be in trouble. But first of all, here's the context. That was way back when everyone was stuck at home and the stock at the time was $400 a share. Today, the stock is $90 a share, and it's much more stable. So the smart choice isn't finding a trade that can't lose. It's finding a trade where the reward is worth the risk. At $80, worst case scenario, if the stock drops below 80 and you have to buy those shares, you're buying Zoom at a discount, a price it hasn't seen in months. So if you like the company, it's actually still a win. And here's the math on the trade. The math my tool helps show. Over the last 5 years, Zoom dropped more than our percentage that we're looking at only 4 times. That's an 80% success rate. Now let me show you the exact math and rate of return using my screen. Let's hop right in. All right. So let's first start by taking a look at the 52-week chart on Zoom. We're going to look at the options chain, and we're going to choose February 27th, this coming Friday. As I mentioned, the stock is trading at $90.29, and we're looking at the $80 put. Now, it has a pretty wide bid to ask spread, 76 bid and 117 ask, and it last traded at $1.10. Super high volatility, 111%, as we expect because of the upcoming earnings release. The delta is only 15, meaning a 15% likelihood the stock will close below $80 by the expiration date on Friday. Let's calculate our rate of return. We're going to pull up a simple calculator and we're going to divide our premium. We'll assume that we'll collect about $1 in premium, given the bid to ask and the last trade. So if we collect $100, because $1 price times 100 shares is $100 in our pocket, and we're putting up $8,000 to make the trade because it's an $80 strike price, we're making about 1.25% for 1 week's time. Now, if we annualize this figure out by multiplying by 52, if we make a trade similar to this on a weekly basis, and believe me, there are tons of trades very similar to this, you'll be making about 65% on your money. Pretty good, huh? And again, worst case scenario, if the stock drops, you're buying a stock that you like anyway at a discount. Right afterward, you can turn around and sell a covered call, committing to sell your shares after the stock pops higher, and get paid additional premium. So what do you guys think? Do you guys want to take the trade? The $80 put is a safe mathematical play. Not 100%, of course, as nothing is, but mathematically, it's a very good trade. If you want more of this data-driven type of analysis, and you want to get updates on the tech tools that I'm building, drop a comment below. Be sure to subscribe to my inner circle. I'll put the link in the comments section, and it's totally free. That way, you'll be one of the first to know when it's released. I'm building these tools for regular traders to help you get an edge without a PhD in math. If you liked the video, smash the like button, share it with a trader friend, and be sure you're subscribed to the channel for more daily updates. You don't want to miss out. See you guys in the next video. Happy trading.